Dream 100 Business Show welcomes you to the podcast episode. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. I simply love this quote. Understanding various types of equity investments is crucial for both entrepreneurs seeking funding and investors looking to diversify their portfolios. Hey, you are listening to Dream 100 Business Show podcast with Savita Hosamani. We at Dream 100 Business Show are on a mission to help business owners to move to the next level in their personal and business journey by helping them to make smarter decisions. In this show, we decode what goes on in the minds of successful business owners during challenging times and how they converted their dreams into profitable products or services. So, in this episode, we will be focusing primarily into three forms of equity investments, which are angel investing, venture capital investing, and private equity investing. Each type serves different stages of a company's life cycle, involving varying levels of investment and carrying different types of risk reward profiles. So today we will be exploring into the definitions, the characteristics, examples, and key differences of these investment types to get a comprehensive overview. So stay tuned. First, let's begin with angel investing. Angel investing involves affluent individuals who are known as angel investors providing capital for startups and early stage businesses in exchange for a equity ownership or convertible debt. Now, let's look into the characteristics of angel investment. Angels typically invest in the very early stages of a company's life cycle. Many a time, these angel investors will be family persons or family friends or people who are known very close to you. For angel investing, investments amounts are usually small compared to venture capital and private equity funding. They typically range from 8 lakhs to 8 crores onwards. Investments from angel investors are risky because they are investing in the early stage of the startup. So the startup may or may not run, meaning it can give high yield returns only if the startup succeeds. There is no success story many a time. Hence, the risk is high. Angel investors, like as I said, sometimes involve family members or family friends. Thereby, they provide mentorship, guidance, and valuable industry connections as well as they are very much concerned about the success of the business. Now, let's take an example. An angel investor might provide 80 lakhs to a tech startup which is in its seed stage in exchange for a 10% equity. Now that we have understood what angel investing is and the range in which angel investors invest money, let's move on to venture capital funding. So, what is venture capital funding? Venture capital, usually called as VC funding, involves investment firms or funds providing capital to startups and early stage companies with high growth potential in exchange for equity. VCs typically invest in growth stage businesses that have demonstrated some market traction. Sometimes VCs ask for at least 10 to 100 sale orders or 10 customers, something like that, so that they can understand that this company has demonstrated some kind of market traction and it is definitely going to grow. So, with that kind of traction, venture capital investment amounts are larger, usually ranging from 4 crores to 80 crores. Many a time, what this venture capitalists do is that they don't directly put all the money at once. There will be multiple rounds of VC funding, series A, B, C, etc., depending upon the stage of growth of the business, so that the VCs don't burn their hands at once. VC firms often take an active role in the management and the strategic direction of the company. They also sometimes take the board seats as well. Now, let's take an example for a VC funding. A venture capital firm might invest 40 crores in a Series A round for a biotech startup that has developed a promising new treatment. So I'm just giving this as an example. The range might vary. So now you know how angel investors invest and how venture capital investors invest. Now let's move on to the private equity funding. Private equity funding, what does that mean? Private equity PE funding involves investment firms providing capital to more mature companies in exchange for an equity. The goal is often to improve the company's performance and sell it to a profit later. PE firms typically they invest in established companies with stable revenues and profitability. Investment amounts are big, often in the range from 80 crores to 800 crores or more as well. Private equity firms often acquire a controlling interest in the company, and they may even restructure operations, management, and strategies so as to improve the efficiency and profitability. The goal of private equity funding is usually to exit the investment through a sale, public offering, or merger within a few years. Now, let's take an example. A private equity firm might invest 400 crores to acquire a controlling interest in a manufacturing company, improve its operation, and then sell it for a higher valuation after 5 years. So, now that we have understood what private equity investment is all about, now let's look at the key differences. Angel investing is usually for early stage startups. Venture capital is for growth stage companies. And private equity funding is for mature businesses. Now, let's look at the investments. Angel investments are smaller, VC investments are larger, and PE, that is the private equity investments, are the largest. Now, let's look at the level of involvement. Angel investors and the venture capitalists are more hands on, while private equity firms often take control and they implement strategic changes. Now, let's look at the risk and return from each of these investments. Angel investments carry the highest risk, but they can yield the highest returns also. Venture capitalists balance risk and return with significant growth potential. And private equity investments focus on stabilizing and improving established companies for profitable exits. Private equity funding is very, very clear. So, in summary, angel investment Venture capital investment and private equity investment are essential components of the financial ecosystem. Each of them play an important role in business growth and innovation. Angel investors provide critical early stage funding and mentorship. Venture capitalists fuel the growth and expansion. Private equity firms drive efficiency and profitability in mature companies. Understanding the nuances of each type of equity investments can help entrepreneurs identify the right funding sources and enable investors to make informed decisions. By leveraging these insights, businesses and investors alike can navigate the dynamic landscape of equity investments more effectively. So, I hope all of you have got a picture of what angel investors and venture capital investors and private equity investors expect from businesses, and businesses also can now tune up to understand to what range they can receive funding depending upon their growth and the stage of business they are in. So thank you so much for tuning into this episode, and we hope a happy funding journey for each one of the businesses who are listening to this episode. Thank you for tuning to this episode of Dream 100 Business Show. I hope you found these insights helpful as you navigate your business journey and the funding journey. So, if you have enjoyed this episode, don't forget to subscribe, leave a review, and share it with your network. Until next time, keep growing and keep expanding. Thank you so much. And as usual, we are always waiting to hear from you. Thank you again.